We continue with our discussion on AFM Unit 4 around debt repayment schedules and how do we look at specific mechanisms in which we can repay the debt. And we've already looked at a couple of mechanisms where we had looked at equated installments or equal installment and a proportionate payment or equal principal repayment. We have seen these two. The next two methods that come to our mind are the first one that we're going to discuss is if there is a customized payment schedule that's been given by the bank to a company, and the next one is where depending on the cash flows, what's happening to the payments. If the cash flows are more, you want to pay more. If the cash flows are less, you want to pay less. So the fourth kind of schedule is going to come based on that, right? Let's begin with the customized payment schedule, right? Now, under this method, usually the company and the bank agree on a specific customized payment schedule. It could be higher in the first few years and lower subsequently, or vice versa, lower in the first few years and then higher subsequently. It completely depends on what the company and the bank want with the scenario. Sometimes companies want to take a loan for a project that is probably not profitable in the initial few years, not profitable initially, right? If you're taking a project which is not profitable initially, you want to pay less in the initial years, pay less initially, right? And then as the viability increases, you are willing to pay more over a period of time, but initially you don't want to pay too much. And so this kind of a mechanism also becomes a common mechanism that comes across companies. Now let's look at what's going to be the scenario. So the same example, 150 crore loan taken, 9 years, interest rate 8%. Now the bank has asked the first 4 years to be 5% repayment of the principal, next 5 years 16%. So we are seeing it's going to be 5%, 5%, 5%, 5% for the first 4 years, that 20, and then the next 5 years is 16, 16, 16, 16, 16%, remember, and that's going to be 80 over the next 5 years. So you're repaying the entire 100% of the loan, but on the first 4 years you're only paying 5% each. On the next 5 years you're going to pay 16% each, right? How do you model this? Straightforward. Let's create a schedule on the Excel file. So under the custom repayment schedule, what we're going to do is we're going to have some terms which are going to be similar. So let's actually just copy this and paste this here. And we're obviously going to change a few things here. So we're going to insert a row here that's going to say custom payment schedule, and we're going to populate this with 5% for the first 4 years. This is in percentage terms 5% for the first 4 years, and then this 5% changes to 16% fifth year onwards. So from the fifth year this number is going to be 16% of the principal, right? Now that's the schedule that the bank has given, so obviously the numbers are going to change. My principal repayment is going to be a function of 5% multiplied by the initial value. Remember, now we are only looking at the initial value. This will keep changing, but I'm taking a percentage of the initial value only, not the written down value, right? It's still similar to straight line depreciation where I have to take 5% or 16% of 150 and not what is left, right? So sorry, this is the principal repayment is going to be 150, and let's freeze that into 5%. So that's 7.5. Subsequent year 7.5. For the first 4 years this number will be 7.5, and then 16% is 24. So over the next few years, just one sec, over the next few years we're going to see a bigger payout of the overall principal. So what we arrive at by doing this is we still repay the 150, but in this case, in the first 4 years, the payment is lower, and subsequent 5 years, the payment is much larger. One interesting thing we can try and see over this point, closing principal becomes zero, is what is the total amount of payment that we have done? What is the total amount of payment we have done? So if you actually just take this sum over this period, that's 223 crore is what you have paid. If I had done the same for this set of data, I had just taken the sum, let's say for the equal principal repayment, that was 210, and if I had taken the sum for this set of data, this would have been 216 most likely, right? So 216 is what I had paid. So equal principal, obviously, because it starts paying more amount of principal right away, this results in your best profile in terms of the least amount of payment. Equal installment is the next. Custom repayment completely depends on how we are modeling it. If we were to change this entire scenario to something like 10% in the first 4 years and then 12% in the subsequent years, correct? So I can take this and drag it ahead. So in this case, we would have paid lesser, right? If we had paid zero in the first, let's say out of the 100%, the first 4 years was zero and the next 5 years was 20%, because we are paying bigger interest component, there is no repayment happening in the first few years, we will see a significantly larger interest outgo over this period, right? So that's the nuances that we can try out and play around with our discussions here. We go back to our initial calculations of 5% and 16% here, right? So that's broadly how we would go about creating a custom repayment schedule. The next one is an interesting method now. So far what we have done is we have said that, there is a payment that is due and we have to make that payment regardless of where the company's cash flows stand. Now in real life, this scenario of whether the company was making money or not, we have to make a repayment schedule. That may not be practical, because if you don't have the money, how are you going to pay? So here we will assume that debt payment would depend on how much cash the company has to repay debt. And this can be captured by a debt service coverage ratio. This method of debt being paid based on the debt service coverage ratio is called as debt sculpting, right? This is called as debt sculpting, right? Now, how does it work? If my cash flow is more, I repay more, right? If my cash flow is less, I repay less. That's the broad premise. To go ahead, let's first understand what is the debt service coverage ratio. Now for a company, what is the cash that is available? Remember, EBITDA is the operating profit. From this, to repay interest, depreciation and amortization are non-cash. So if I just remove the tax, this is the amount which is available to be used for repayment of interest and principal. So my debt service coverage ratio is nothing but the cash flow available, that's given in the numerator, divided by the principal and interest repayment, right? Now for our company under consideration, we have an EBITDA for the next 9 years, and we can create a debt profile based on the EBITDA and tax data that is given for the 9 years as follows. So the company makes these EBITDA numbers and repays these tax numbers. The difference between these two is the cash flow available for the debt service, right? So cash flow available to service the debt for debt service. That's what we are going to use an acronym for, CFADS. That's the cash flow available for debt service. Now, what is the question? Let's assume the company wants to maintain a DSCR of 2. So what is the equation? Debt service coverage ratio is equals to cash flow available for debt service divided by principal plus interest, right? We are saying this should be equal to 2, which basically means principal plus interest should be cash flow available for debt service divided by 2, and consequently, principal should be CFADS divided by 2, whatever debt service coverage we have to maintain, minus the interest component. Correct? That's what we're looking at. Let's model this. This is going to be an interesting model in the Excel. So when we go to debt sculpting, we obviously get the data around the EBITDA and the tax. So let's first introduce this term cash flow available for debt service, and that's going to be A minus B, right? We will also introduce a row here just to insert what is the expected DSCR, debt service coverage ratio. That's expected to be 2, right? If DSCR is expected to be 2, we can start with our discussion on the principal, beginning principal, and so on and so forth. So let's actually just write it here. Beginning principal is 150, right? I can calculate the interest. Let's put principal repayment and interest payment, and that would give me my total. And remember, we said if I want to maintain a debt service coverage ratio of 2, then 2 is equals to this cash flow available divided by P plus I. Principal repayment plus interest is going to be cash flow divided by the debt service coverage ratio. So the total installment that is going to get paid, right? Total installment or amortization is my cash flow divided by the debt service coverage ratio. That's the total that I'm going to pay, right? So F4, I will freeze the debt service coverage ratio. That's what I'm supposed to kind of repay over this period, right? This is principal plus interest, remember. Can I calculate the interest here? Can I calculate the interest payment? Interest payment is straightforward. Whatever is my debt multiplied by my rate and frozen, that's my interest payment. So if the total installment is 28, we have 56 as cash flow that is available for debt service. Out of 56, we are saying we want to maintain a debt service coverage of 2, which means we can repay 28. If we can repay 28 and 12 is the interest, then the principal should be 28 minus 12. Once we get this, we get the closing principal, which is going to be 150 minus the principal repayment, which is this. Next year beginning principal is going to be 134. Interest calculation is going to be 10.7, which means principal repayment is going to be 12 minus this, and hence closing principal would be this. All I need to do is just drag it for the next few years now, right? And what we realize is that the entire loan gets repaid by the final year based on these numbers. We get to a negative number. So we don't need to have a negative number because once the loan gets repaid, we don't necessarily need to have it. Look at the third year, for example. We start with a principal of 132, interest is 10.6, cash flow available is 48, so we can pay a total of 24. Out of 24, 10 is interest, so the remaining 13.4 is the principal. Once we calculate the principal, closing principal comes there, and subsequently we keep repaying the interest and the principal repayment. At one point, this number, closing principal, will become 0. Now this is a very, very important understanding in real life, because in real life practically companies are going to work based on what cash flow do they have available for repayment, and that cash flow available for debt service is nothing but EBITDA minus tax. So let's recap what we did. We said debt service coverage ratio is EBITDA minus tax, which is a term called cash flow available for debt service, divided by principal plus interest. We are saying that if a company is maintaining a debt service coverage of 2, then they are saying that total cash flow that they have has to be twice of the debt that they are paying, right? total cash flow that they have should be twice of the debt that they are repaying plus total debt service that they're doing, which is principal plus interest. So P plus I should be the cash flow divided by the debt service coverage required. So consequently, the principal can be calculated. We assumed a debt service coverage of 2. If we assume this to be 1.5, for example, you will find that you end up paying debt much earlier, because now you are able to pay more every year. So you basically repay it by the sixth year itself. Once it becomes negative, it doesn't make sense, because you're not going to kind of get interest on this. Effectively, you would have zeroed the loan and repaid and finished it in somewhere in the sixth year, right? If you had to maintain 2.2, then the loan continues even at the end. In fact, in the second year, you don't really repay anything in terms of the interest component, right? So depending on how much cash you have, and depending on what is the comfort level you want to keep in your business in terms of the amount you're paying, that's what is called as debt sculpting. You're going to maintain a target debt service coverage ratio, and based on the premise or the discussion that we have had, this company ends up paying the money at the end of the 8th year, somewhere at the end of the 8th year and beginning of 9th year, somewhere in between. If you look at the total sum of the installments that have been paid, you're paying roughly about 220. This is going to be erratic. This is not going to be exactly the same as what earlier calculations were, because in this case, you are assuming that the principal repayment is a function of what cash flow is available with you. If the cash flow changes, the debt repayment also changes in this particular example. That is what we mean basically by debt sculpting. So just to quickly summarize, there are 4 methods that we have discussed, which we are also seeing on our Excel file. There's an equal installment, which is an equated monthly installment or annual installment kind of a discussion. There is an equal principal repayment, where every year the same amount of principal is repaid. There's a custom repayment schedule, where sometimes the bank gives us what is the repayment schedule, and the company pays the principal according to that repayment schedule. And finally, there's something called as debt sculpting. Debt sculpting is nothing but a scenario where the company is repaying principal based on the actual amount of money it is generating year after year. That's a very practical scenario, because in real life, it is necessary to know how much money you are having at any given point of time in terms of what you want to repay. Correct? So that's basically our understanding of the various methods of repayment of debt. And as we end this particular video, a couple of quick questions. Explain the concept of debt sculpting with an example, and which debt repayment method looks the most practical from a real life perspective. That's it in this particular video. Thank you.